Hey guys, it's Andy from Magoo Investing. Today I'm going to be talking about double bottoms and what it means to trade them and how to spot them on the chart so you can trade them moving forward. So as I've talked about on this channel a lot, my favorite types of trades are the stocks that are super undervalued, they've been doing very poorly for a while, and I'm looking for the reversal. And one of my favorite indicators for when to jump into a position is the double bottom. And so I've talked about on this channel before, support and resistance, and that's basically what we're going to be doing today. We're going to be looking for a support to be tested for a second time, and if that support gets validated and moves to the upside, we're going to be taking a position. So in this video, I'm going to be talking about the different types of double bottoms that you can be using, and that kind of sounds kind of weird because a double bottom's a double bottom. But it really depends on the time frames that you're looking at. If you're doing a short-term swing trade, a double bottom and within 1 week could be an indication that you should be taking a trade, or if you're looking to be holding for a month, year, into the future, the double bottom over a longer time frame is going to be your indicator, and not if it happens within a week. So the first one I'm going to be talking about is the short-term double bottom trade, and things you're going to be looking for is a increase in trading volume. And so when it first hits that initial support level, and it shows that there's some pretty good support there and it bounces off of that, if it comes down, test that support level again, and goes green the next day with higher volume, that's a good indication that that support is going to be holding, and you may be able to swing that trade for a percentage or two pretty easily. But with a lot of these short-term trades, the huge risk involved in it is you might get faked out pretty easily. Just letting one candle set or just 1 day of trades be your indication for taking a trade. If something happens in the market and everything gets pulled down, your stock is going to be pulled down with it. So it's kind of hard to trade these because something that's completely out of your control can just kind of ruin your trade. But the basics of the increased volume on the green candle after the double bottom is mainly the best indication for if the stock is going to be pushing higher. All right, and the next type of double bottom we're going to be talking about is the medium term trade. And this is kind of the trade that I'm looking to hold for a month to maybe 4 or 5 months, probably not longer than that. And the things I'm looking for is a solid support where it's not just touched at one time, it's kind of hung around at a certain level. We'll just call it the $50 mark. And then over the past month or so, it's gone up to maybe $75, and it's come back down and it's sitting around $50. And so unlike the short-term trade, I'm going to be a little more patient waiting for this trade to unfold. And so we're kind of going to be playing this kind of like a support and resistance trade, where we're waiting to make sure that support level holds, and if it does, we're going to let it ride to the upside a little bit, and the target for our trade is going to be the resistance that it last hit on the way back down. And so we're going to hop over onto the computer. I'm going to show you a perfect example of how I would have traded this. This is not a trade I took, but just going through and looking at some of my prior watch lists, I saw this and was like, whew, man, that is a textbook example of the medium-term double bottom trade that I'm looking for. All right, so here we are looking at JP Morgan Chase, and this is kind of more of the short-term trade that we've been talking about, even though the range that's been going through from 105 to 115 isn't that great. That's kind of just how it's been going recently. It's not a very volatile stock. That's kind of how these banks and financial services companies are, but we're going to be talking about the shorter-term play that I missed kind of recently. So actually, let's get out of here. So this is what it's looked like for the past 180 days. It came onto my radar when it tested around here because I had this as a support. I've cleared off all the drawings since then, but this was a support that had been used before. It's been used all the way back over here. It pushed up, came down, pushed up again, and came back and retested it. And so for the shorter term trade, what we'd be looking for is the break above this previous high. So the trade that should have happened was I get notified when it comes back to here because I should have charted it when it hit the support or when it made the support. And now I'm watching it on the way up. And what we're looking for is the break above this previous high, which shows that there's some upward momentum, something that we can be trading on the way up. It's been kind of validated that it's going to be moving. And so I should have entered this trade right about here. There's, let's see, 110 to 120, pretty decent trade. I missed it, but this is a great example of something that you're waiting for it to push above the previous high to validate the double bottom and to make it seem safer instead of it reaches that double bottom, it touches it, and then it just continues to fall. Because in the past 180 days, the range has gone down to $98, and you would hate to take a trade at 105 because it's been a previous support. All it takes is some bad news, some big seller to come in, push it all the way down, and now you're riding it to the bottom. So important step right here, validating or breaking the previous high. All right, and the final type of double bottom trade I'm going to be talking about today is the long-term trade. And the setup that we're looking for on this is the bottom where the support is set. It's going to push up higher, and then it's going to come back and retest it. And so this is not going to be one of those charts that you look at and everything's just been declining and you get one little push off the bottom. That's most likely going to break the support and it's going to keep falling further. We're looking for something that's kind of been horizontal for a while and you're waiting for it to break off out of that support. And so similarly to the short-term trade, actually, you're looking for the increasing in volume. And the reason you're looking for that is you want the buying pressure to be increasing because that'll help indicate that the stock could be pushing higher in the future. And so if you see a stock where the bottom is formed, it goes up a little bit and it comes back and retests it, but the volume isn't very high, all it would take is one large seller to push it below, break the support, and as we've talked in the past, when a large support is broken, it tends to fall a lot further and very quickly. So the increasing volume is kind of your safety net, and so the higher the volume is relative to normal trading volume, the more confident you can be with that trade. If it's kind of average volume, it probably could be a decent trade, but if you have very high volume or if there's some news story that's pushing it higher, that's the type of momentum I like to trade, and let me kind of ride that all the way up to the top. With that news, increased volume, it's going to start popping up on more people's radars, and the more people that are trading it and buying, the share price is going to go up and you can get a pretty nice trade out of it. And so now to finish off this video, I'm going to talk about some of the cons and some of the risks that you're putting yourself in the way of if you're going to be using these double bottom trades. And so one of the main things and the most obvious things is you're trading around a support. And so whenever you're trading around there, all it takes is one large candle to close below that support you're trading for the bottom to fall out of the stock, and you get some very negative momentum pushing the stock down even further. And now after you just took that trade, you're feeling really optimistic. Maybe you go to the gym or something, you come back and all of a sudden you're down 3, 4, 5% just because that support broke and everyone sold all their shares. And so this is why it's really important for you to kind of wait to take your trades. If you're going for the shorter term trades, you need to have that stop loss. You need to be ready to sell that trade if things go south quickly. But if you're on kind of a longer term trade, maybe a week, maybe a couple weeks to a month, that's kind of where you set that 1% stop loss just below that support, where if it does break, I'd much rather take a 1% loss and maybe it pushes up higher than have it just kind of fall through the bottom and have kind of a catastrophic trade that really ruins the whole momentum of your account and kind of pushes you down morally. And then the final tip that I'll give for these types of trades is trade something that it's a stock that you've heard of, stuff that's trading on decent volume, because when you have the lower volume stocks, kind of why we tell people, or why everyone says to stay away from penny stocks, is when you have really low volume, all it takes is for one whale, as you kind of call them, to come in, sell a bunch of shares, things plummet, they buy back in, pushes it back up, and now you have these really weird candles where you'll see them sometimes where it's a really long wick that comes down, doesn't close down there, just goes down, and then shoots right back up. And basically what that person is doing is a large share size was sold, stock price falls, everyone else, the stop losses trigger, stock falls, and then that person that sold all those shares buys right back in. And so this is pretty common for banks to do, investment brokers, and it's kind of something you need to watch out for. The higher the volume, the more confident you can be that that isn't able to happen, because it takes a lot more shares to move something like an Apple or a Microsoft than it would be to trade like a 50-cent penny stock that's getting 50,000 shares traded a day. And so overall, this is probably my favorite type of trade to have. It gives me a set entry and exit point and a stop loss if things go south, and it's something where I can kind of watch a stock fall, watch a support be built, and if things go well and it retests that, I can be waiting to kind of jump on that trade, depending on how much validation I need for this trade to be worth it in my mind to put my money into it. And if it's a short-term trade, all it really takes is one candle for me to jump in there for a couple days, where if I'm going for a longer-term trade, I'll look for a couple green candles, the increased volume to be my indication that I should be entering the trade. So let me know what you guys think about the double bottom if you've been trading it recently. It's kind of hard to trade when the stock market's been doing pretty well, but for the past couple months, I guess in the red months of June and last winter, the double bottom was something I was trading a lot because the whole market was falling, and all it took was one good news story for the stocks I was looking at to get that momentum to push it forward, because people are looking for better bets when the whole market's going. So thanks for watching, guys. If you enjoyed it, if you learned something, please hit that like and subscribe button. It'll help my channel out a lot, and I'll see you guys in the next video. Thanks for watching.